Markets are on yen intervention alert. Australian inflation data was softer than expected. China's industrial profits beat expectations. And New Zealand's government is set to borrow more as its economy slows. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Pacific economist Kishti explains why Papua New Guinea's depreciating currency, the kina, is not driving structural change in the economy.
My view is that the Papua New Guinea has got a permanent solution to its foreign currency problems. If it can get one of the major projects underway very soon, then it will bring in capital flows into the country and will restore a balance into the foreign currency market.
But first, in 5 and 5 with ANZ, traders are on high alert for yen intervention after an emergency meeting in Tokyo overnight of the Bank of Japan, the Finance Ministry, and Japan's Financial Services Agency. The yen slumped to its lowest levels since 1990 during Asian trade yesterday. It almost went through the 152 yen to the dollar mark, which some see as a red line for intervention. News of the meeting saw the yen bounce to 151.38 by 5 a.m. Sydney-Melbourne time. It actually got to a low of 151.97 yesterday. Officials have talked tough in recent days, but have yet to pull the trigger on intervention. ANZ Head of FX Research, Marjabeen Zaman, says the authorities are more worried about volatility than the absolute level of the yen.
Given that volatility of the move is not very much significant, it's been gradually moving higher over the past days, I would assume that the bar for intervention is a little bit higher than previous levels. Previous interventions, they only had a short-term impact to take the dollar-yen lower, but broadly, again, it's really the US dollar and yen rate differentials which really drive this currency.
The Aussie dollar was solid, around 65.25 US cents at 5 a.m, while the Kiwi was a touch below 60 US cents at 59.98. US Treasury yields were down a couple of basis points, and the S&P 500 was up 0.4%. But trading is thin. Everyone's waiting for US inflation data later tonight and the Easter holidays. Number 2, Australian inflation came in a touch softer than expected at 3.4%. in February from a year ago. ANZ economist Maddie Dunk says that's consistent with ANZ's forecast of March quarter inflation of 0.5% versus the RBA's 0.8%. There was some devil in the detail, though.
There are some signs that we could see inflation be sticky and that inflation might struggle with that last mile challenge. So domestic drivers of inflation, services inflation are both above 4% and do look to be a bit stickier than some of those global factors.
Number 3, Maddie says the February data did help answer one big question, though. Just how big was the Taylor Swift effect on the Australian economy?
The Taylor Swift effect was really, in the end, quite overplayed. We thought that it might have a bigger impact than it ended up having in the data. ABS noted that while hotel prices in Sydney and Melbourne went up as people travelled to go to the concerts, that was offset by weakness elsewhere in travel prices because the school holidays ended at the end of January. And because of that, everyone's back at school. Families aren't travelling as much. So we'd seen less demand in the broader economy.
Number 4, Chinese industrial profits in the first 2 months of 2024 rose 10.2% annually, which was stronger than expected. ANZ senior China strategist Xiao Pengxing says exports boosted the figures, but further stimulus may still be required to hit China's 5% GDP growth target this year.
In the industrial performance data, only the industrial inventory can contribute to GDP. In the first 2 months, the industrial inventory, nominal inventory, increased only 2.4%. So I guess that, this is a good sign for the 5% GDP target, but remain insufficient. The additional monetary or fiscal policy, I think, will be necessary in the next few quarters.
Number 5, New Zealand's budget policy statement yesterday gave off mixed signals ahead of the full budget on May the 30th. ANZ senior economist Miles Workman says updated Treasury forecasts signal $14 billion less tax revenue will be collected over the next 4 years than was expected in December. The big question about spending and tax cut intentions will only be known on May the 30th.
On that front, it looks like it's about par, perhaps maybe mildly less expansionary than at the half-year update. So when we put all the numbers together, we're coming up with a rough guidance that perhaps New Zealand Debt Management will need to lift their bond issuance guidance by about $10 to $12 billion over the next 4 years when the budget comes around.
Miles Workman there. Now, in today's deep dive interview, ANZ Pacific economist Kishti says Papua New Guinea's currency depreciation has not driven structural economic change, meaning it's relying on more large natural resources projects to drive growth.
The currency has been depreciating since 2014, when the capital inflows associated with the transformational PNG LNG project dried up. There were no new major greenfield or even brownfield projects to replace it. And without those capital inflows, Kina started on a downward track. It didn't go anywhere in 2022, but the slow depreciation started again in 2023. And by the end of 2023, the Kina was about 5.5% lower in value at 26.8 cents US. But the currency depreciation since 2014 has not really led to better performance of the domestic trade-exposed or Kina-sensitive industries in Papua New Guinea. Now, in the energy and minerals export sector, generally speaking, firms are already producing at capacity. It's the same story in agriculture. Your bags of coffee, your tons of cocoa and palm oil has been fairly constant over the last decade. Now, we haven't seen a material shift higher despite a more competitive Kina. And in terms of some of the other domestic trade-exposed industries, Papua New Guinea does not have a large manufacturing or tourism base to take advantage of a lower Kina. So currency plays a limited role in driving structural change or allocating resources to more productive areas of the economy. Not yet, at least in Papua New Guinea's case.
So if you can't rely on a lower Kina to really push along your exports, what could policymakers and decision makers in Papua New Guinea do to try to increase their export receipts and their ability to improve output?
Well, Papua New Guinea does have a rich endowment of natural resources. That's the good news. And the Papua New Guinean economy and the foreign exchange market as well, they do very well, actually exceptionally well, when Papua New Guinea harvests its rich endowment of resources and brings it to the global market. Now, it's not only investment in the resources that benefits a few construction or construction services firms which are plugged into the building sector. Investment in Papua New Guinea's resources sector actually broadens growth and takes GDP into a higher level.
How long do you think it'll be before PNG's economy is more mature and the currency does more of the work?
My view is that the Papua New Guinea has got a permanent solution to its foreign currency problems. If it can get one of the major projects underway very soon, then it will bring in capital flows into the country and will restore a balance into the foreign currency market. And that, I think, is the most sustainable way of restoring steadiness in the foreign currency market. It's the capital inflows associated with the foreign direct investment into Papua New Guinea's resource sector into the future. The good news is that the top four, as they call it, in the energy space, such as your Barrick Gold, your Newmont, ExxonMobil, and Total, they're all looking to do another round of investments in the resource sector.
Kishti Sen there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 28th. Catch you on Tuesday after the Easter break with analysis of key US inflation data due tonight. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.